So let's get started with Phil. Why don't you get started? Take it away. Thanks so much. Phil?
Marty, thank you very much. And for the participants in the call, you were promised the CEO of our firm, Oliver Wright, and we got a call on Friday that Oliver wouldn't be able to be with us today, and I am happy to pinch hit for Oliver along with my colleague Alex Nergizian. Now, Oliver is a brilliant and experienced veteran of the structured credit businesses and the CLO markets. And I think between Alex and myself, we're going to be able to cover all of the things that this group is going to want to know about CLOs. The great thing is Alex knows everything and I know the rest. And so I think we'll be able to present well in Oliver's absence. Marty, thank you so much for organizing this and for allowing our firm to be represented here today and talk about the opportunities that are available in the CLO space for family offices. Alex is going to share with you a slide deck for this discussion. Alex, I don't know if folks can see Alex. Alex is a handsome young man in a proper shirt and tie, and after
get out of here, you scavenger.
Actually, I've been wearing a suit and tie for about 41 years since I left Wharton as an undergrad in 1979, and I would say this is. The shirt I'm wearing now is the most formal I've been in the past 4 months since we went into the shelter in place. DFG is a boutique firm, and boutique in that it specializes in a narrow corner of finance, and that is the structured credit business, specifically in CLOs. The firm was established in 2006, and all we do is CLO investing. Alex, you can put back up my bio. I'm happy to talk about that for a little bit. I joined the firm in 2013 after a long career at Goldman Sachs. I had the good fortune of being a pre-IPO partner, and I ran a number of the credit businesses at the firm. Alex has worked, and his only job since leaving Boston College has been at DFG in a number of different roles, and he directs our business development effort in New York City. The firm was introduced to me by a very dear friend in 2013, and I came to the firm looking to invest in CLOs. And I was so attracted by the firm's risk management and technology capabilities that I took advantage of the opportunity to invest in the firm and to become the firm's chairman, which is a role I've enjoyed since, I guess, late July of 2013. Again, I mentioned that the firm was started in 2006. It is owned by the employees and managers of the firm. And Alex, we can be on the next slide. I love looking at pictures of myself, but maybe others would like to see some substance here. Thank you. So the firm has a very significant minority stake from AIMCO, Alberta Investment Management Company. We have about 30 people in our office in New York. And interestingly, we have a technology team. We have about 4 technology experts, maybe 5 technology experts in New York City. And then there are 16 that are in an affiliate we own in Turkey. We've identified Turkey as being a great source of technology expertise and capabilities with a very attractive cost for us. So we have in total 46 people, of which 20 of the 46, 4 in New York and 16 in Turkey, 20, all involved in technology. And we consider technology to be a core competency of the firm and a way we can differentiate our performance for investors and also in risk management. So the firm operates in two areas within CLOs. We are a manager of CLOs, and in that area we have a large group that does credit analysis on corporate credits that comprise the portfolios that are part of the CLOs that we issue and manage. And that's about a $5 billion business for us. And then we have almost $2 billion of CLO debt and equity that we manage for institutional investors and for family offices. Those funds are in various different funds, some SMAs, some funds that allow for commingled investors, and I have, across these different opportunities, my own money, about $5 million of my own money in these different CLO debt and equity strategies. My investments are all in the mezzanine debt space and the CLO equity space, which is the area I found most attractive and what I was looking to do in 2013 when I was evaluating different CLO managers to allocate my own capital to. I think that gives you a sense of who we are at DFG. It's a large AUM in a very narrow area of the market. The two disciplines complement each other. Our credit team can support the team that's investing in CLO equity by helping that team understand the characteristics of portfolios of credits that are the core opportunity in CLO equity and CLO mezzanine debt. CLOs are fascinating, and Alex will go into more details on the CLOs because they offer a risk-return spectrum for just about every investor. They have AAA assets that are part of CLOs that are appropriate for the most risk-averse investors. And then at the other end of the extreme is CLO equity, which has very significant risk and return opportunities, and especially so in the current environment.
And Phil and Alex, I just wanted to jump in here.
Sure, Marty.
Can you discuss also how this market has grown? Because I think that the CLO market was a lot smaller 10 years ago than it is today, and you know, a lot of people are frankly surprised. Is it $1 trillion now, larger than $1 trillion? Because I mean, you manage $7 billion, but that's really not a lot compared to the market size.
I'm going to say when we first met, Marty, in 2013, 2014, there were about 300 million CLO debt and equity outstanding. And at the time, they represented about 60% of CLOs represent 60% of the outstanding leverage loans. Leverage loans have doubled in size, and CLOs have more than doubled in size. So now the CLO market is in excess of 700 million, and I think leveraged loans is closer to $1.3 billion, $1.4 billion. And Alex can go into that in greater detail. Now the CLO market, it was bifurcated into sort of the pre-financial crisis market, which was about 100 million in size. And then by 2014, the CLO 2.0 market had grown to a couple hundred million, and now it's about 700 million in size. About 10% of the market is CLO equity, and about 10% of the market is the mezzanine sector of CLOs. Those are tranches that are BB and BBB related. And our firm invests in our structured credit business. We have some funds that invest only in AAA. We have some funds that invest only in investment grade. We have some funds that are focused entirely in the mezzanine sector. And we have some funds that are concentrated in CLO equity. So in our asset management activities, we're investing across the yield curve because of our capabilities. When firms are putting deals together, we get calls because a deal comes together when the AAA and the equity is circled, and because we invest in AAA and equity, we get calls from managers and from underwriters and dealers in the early stages of structuring deals. So we get a peek at it at the very beginning. Most of the opportunities that we invest in, we're investing in pre-issuance stages. Marty, I hope that answers your question. I'm going to, on more details on the CLO market and its growth and the details underlying CLOs, I'm going to ask Alex to pick up from here and continue on with sort of walking through some of the slides we put together. Alex, please take it from here.
Great, thank you, Phil. And Marty, thanks again for setting this up. We appreciate it. As Phil mentioned, we've been involved with your events since I think about 2014, and it's been a fruitful partnership. Thank you so much. Let's just go quickly to a quick refresher of what a CLO is. So when you think about a CLO, you think about it as a balance sheet. So the assets that CLOs invest in are first lien senior secured bank loans. By mandate, these portfolios have to be highly diversified. So typically you have 100 to 200 issuers. These are first lien loans issued as part of LBO transactions, as part of sponsor-backed transactions that are distributed in what we call the broadly syndicated loan market. And by mandate, they have to be highly diversified also by sector. So CLOs have concentration tests that mandate that you have to be sort of 25 to 35 industries. No industry can be larger than 15. And there are over 100 different tests that managers have to maintain on a monthly basis in order to actually manage a CLO portfolio and maintain their ratings. So looking at the capital structure, roughly 75% of the CLO structure of the financing comes in the form of AAA to single A rated debt. The AAAs in particular are about 60% of the structure. And then moving down, as Phil mentioned, triple B to single B can typically be about 10 to 15% of the structure. They are junior to the AAAs, AAs, and single A's in the cash flow waterfall. And then lastly, you have the CLO equity tranche. This is effectively akin to owning bank stock. CLO equity makes money by borrowing at, let's say, LIBOR plus 200. That's the weighted average coupon of the BB up to AAAs. And let's say investing in loans at LIBOR plus 350. You have 150 basis points of net interest margin that goes to an investor. If all goes well, goes to the investor that holds 10% of the structure. So that's effectively 10 times leverage. That gets you to roughly 15% teens type running cash flows on an annual basis. What else is important to know in the structure? There are no asset liability mismatches. So this was pretty key for the pre-crisis CLO performance and why CLOs did well. You're investing in floating rate loans that earn a spread over LIBOR, and you're borrowing at a spread over LIBOR. So you don't have these types of mismatches due to rates. So it's a pretty balanced structure. In addition, you don't have a term mismatch. So CLO liabilities typically have a 13-year maturity. The underlying loans typically have a 7-year maturity and are expected to be called or refinanced within 3 years. That's sort of your average rule of thumb. And one thing that's very important about the CLO market that makes it different than other asset-backed securities is the fact that they are managed products. So we'll get to this a little bit in the next slides, but there are 127 managers that are active in this space. They each have different strategies, styles, different views in the markets. In the pre-crisis world, what we call the CLO 1.0 world, that was a much more concentrated set of investors that were active in the space. Today, it's expanded significantly. So unless, Marty, you have any other questions, I'm going to move on to the next slide.
Yeah, Alex, can you just talk a little bit about the nature of these loans. I think you said they're 13-year loans. Are these amortizing loans, or you just pay the interest and then it's like a bulk payment at the end, or tell
That's a very good question, Marty. So the CLOs effectively, we'll get into the structure. I have a slide on that as well. But CLOs typically have a 5-year reinvestment period, 4 to 5 year, depending on the deal. So what that means, during the reinvestment period, the CLO manager will redeploy proceeds from any loan prepayments and maturities or risk sales. Let's say you don't like the Hertz loan anymore and you want to go buy into something else. You're able to redeploy those proceeds into new loans during that reinvestment period. Thereafter, basically what ends up happening is any principal proceeds that come from those loans are effectively used to pay out the debt holders sequentially. That'll start with the AAA holders. The AAAs will start to amortize over time with any proceeds. Now that is dependent on the speed of prepayments and maturities, of course, and that's a variable. It's one of the reasons why CLOs are hard to analyze compared to some of the more plain vanilla mortgage products or ABS products that insurance firms like to buy that have a much more defined tenor. So after the reinvestment period, proceeds from principal are used to pay down the structure sequentially. During the reinvestment period, what happens is those are reinvested, and then the interest waterfall is separate from the principal waterfall. So the interest you collect from the loans is really ring-fenced to pay the interest on the financing. And once that financing has been paid off, the equity investor can clip the residual portion. So that's a long-winded answer. The other variable in CLOs is they have a 2-year non-call period, meaning that the equity investors, particularly the majority of the equity, might think 2 years down the line that they could refinance the whole structure cheaper, and they might elect to use that option. So as an investor in, let's say, the AAAs, you have a bit of uncertainty after the non-call period is over. And part of that uncertainty is what makes this an asset class that has historically yielded a little bit more than comparables, particularly for the investment grade part of the capital structure. Does that answer the question, Marty?
Yes, thanks.
Great. So I'm going to move on to the next slide if no other questions. This is going back to the growth of the CLO market, which we discussed. The loan and high yield bond markets have each grown tremendously post-crisis for different reasons. The loan market, one of the main reasons why it grew to about 1.3 trillion today. With rates being as low as they were post-crisis for a very prolonged period, investors had a significant demand for floating rate paper. That's pretty common. We actually saw a significant growth of loan mutual funds as well. You might have seen senior loan or bank loan funds marketed by various investors. There are also a variety of ETFs that have sprung up to buy this asset class as well. As important as those were, however, what was really important to the growth of the loan space is the CLO market, because as retail investors and other types of investors sought floating rate paper in more of the mutual fund market, for example, large institutional investors like banks, including foreign banks, wanted to put on low risk floating rate investments as well. That created demand for the CLO AAA part of the capital structure, which, as we mentioned, that's 60% of your financing. So it's a pretty significant, in a $500 million CLO, 300 million of your capital structure is typically a handful of investors buying that AAA tranche. So that helped to grow this market. As mentioned, we had 127 active CLO managers in what we call the broadly syndicated space today. So this excludes the European CLO market, which is a lot smaller. It's about 1/10 of the US market. And it excludes what we call the middle market CLO business, where a lot of the private credit and direct lending firms that you see active in BDCs or in private credit funds may have an arm that takes financing on their private credit portfolios using the same technology. So 127 managers, the top 20 firms in this space control roughly 50% of the outstanding. And it'll come as no surprise, a lot of those firms are large private equity backed firms. We're talking about the Apollos, the Blackstone, GSO, Ares of the world. There are also some specialists. Credit Suisse Asset Management is the largest CLO manager today in the US, and a handful of others who form this large cohort. And as mentioned, there can be very different styles and strategies approached by each of these firms when structuring their deals and when managing their underlying loan portfolios. I think that's an important point. CLOs account for more than half of the 1.3 trillion loan market. So today, if any of these private equity sponsor-backed companies or public below investment grade rated companies wants to borrow money in the leveraged loan market, getting CLOs on board is very important because they typically buy 60 to 70% of all new issuance. With that, if no other questions, I'd like to move on to talk about the structure of the deals of the long run. So,
Alex, as you pull up this slide and you show the capital structure of a CLO, one of the questions that we saw in the chat was the bid-offer spread of CLO securities in the secondary market, and that obviously depends on the security itself and the tranches. And I thought while you had that
sure.
While you had that slide up, and it was the slide you were on, which shows the amortization. You know, that could be, you could use that to talk about some of the liquidity that is in the secondary market for these securities.
Of course, that's a great question, actually. So, this is probably the right slide to look at. When you look at the structure of a CLO, you see how small and thin these mezzanine tranches are and how large the AAAs are. The bid-offer spread is really a function of who the different constituents are in this market who invest in CLOs. AAAs tend to have a pretty tight bid-offer spread. What happens is you have a lot of long-term institutional investors like banks and bank holding companies and insurance firms that buy AAAs and that hold them to maturity. So that's one segment of the market that is typically static. That doesn't really trade much. Conversely, the secondary activity is picked up by insurance firms, asset managers, mutual funds. In some cases, insurance firms who have asset management arms that can be very aggressive in the space. In normal markets, CLO AAAs have a very tight bid-offer spread. We're talking about, you know, it could be on a price basis, it could be 50 basis points to a point at most. And that's in a normal functioning market. That's an important point because we'll talk about what happened in March a little bit after this. AAs and single A's similarly have pretty tight bid offers. Once you get to the triple B to single B part of the capital structure, you talk about a bid offer spread that is in the order of points. So it could be, you know, for triple B's, it could be 1 to 2 points. For double B's, it could be 2 to 5 points. Single B's are a very small market. Most CLOs do not have single B's. They're typically viewed as cutting into the equity tranche from a structural standpoint. So a deal with a single B tends to have a thinner equity at the bottom. And those have a larger bid offer spread. Equity in normal markets can be 5 to 10 points easily. And today is definitely not a normal market for reasons we'll discuss later on. So I think we'll get to where we are today in more detail. But generally speaking, in March, we saw the bid offer for AAAs blow out enormously. And that rippled down the rest of the capital structure as well. Maybe we'll spend a little bit more time on that, I think, in one of the subsequent slides. But maybe I can give a little bit of a refresher here on the structure. Marty, you know, one of the audience members asked about the tenor, the maturities, etc. As mentioned, you have a 4 to 5 year reinvestment period. That's the first 4 years in this chart. The first 2 are a non-call period during which the structure cannot be called or refinanced. The subsequent 2 years are times where the equity investor can be opportunistic. If you have an environment where spreads are tighter, let's say you structured your AAA tranche at LIBOR plus 150 at origination, you're 2 years into the life of this deal, and you think you can refinance that at LIBOR plus 120. And you may have certain costs associated with that exercise. You do the math and you think about a break-even time. If it makes sense, you're highly incentivized to do that. CLOs also have a new phenomenon in the 2.0 world called the reset, where an equity investor may actually try to get a new maturity, a new reinvestment period in full. That's a little bit more challenging to get done because you might have some problem assets in the loan portfolio that have to be worked out. But that's something that's been a very big trend in the 2.0 world that was not around in the 1.0 era. Once the reinvestment period is over, as mentioned, the principal proceeds from loan prepayments and maturities are no longer reinvested. The manager has to start paying back investors. And the way that happens is sequentially. AAAs go first, then AAs, and so on. What tends to happen, which is sort of natural given the math, your AAA part of the capital structure is your largest financing tranche, and it is also the cheapest. So once you start amortizing that AAA, you're ending up with less leverage and a higher cost of debt as an equity investor. And it starts to become very uncomfortable in that respect let's say you were hoping for 4% per quarter distributions, that's going to come down very quickly after the AAA starts to amortize. And that's why we typically expect deals to be called, refinanced, or reset very quickly at the onset once the AAA starts to go away. So unless any other questions, I'd be happy to move on to the next slide.
There's several other questions, Alex. The question on your CLO portfolio turnover, did you answer that?
Sorry, I haven't been monitoring the questions that closely.
Yeah, there's a couple of questions on what is your fee structure, how active is your CLO portfolio turnover, and then the other one is, in the private loan market, banks are charging borrowers a minimum interest floor of 2%. Are
Right.
CLOs doing the same?
Gotcha. Those are great questions. This is actually the best slide to be on. Let's start off with fees. The typical CLO fee structure historically has been 50 basis points on the entire portfolio and a back-ended incentive fee. What's important to note is that 50 basis points is actually split in two fees. One is your senior fee, which actually in terms of the priority payment sits above the AAA. So this is something that's going to be paid no matter what. That's usually 20 to 25 basis points. And as you run the waterfall using the interest proceeds generated by the loan portfolio, if you have enough proceeds to pay all debt holders and the equity, there's also a subordinated management fee that sits right at the equity level as well. That's typically 20 to 25 basis points. Historically, 50 basis points was the operating number. As AAA costs have been stubbornly wide in the post-crisis era for a variety of reasons, what you've seen is there's been some fee compression. So most deals realistically get done in the 30 to 40 basis points all-in range. As mentioned, the equity is 9 to 10% of the structure. It's a 10 times levered effect. So any 10 basis point savings you can get on the loan portfolio might be another percent IRR to the equity. So it is substantial. The other thing to bear in mind, like certain private credit or private equity fund structures, you have a back-ended performance fee. So typically CLO equity has a 12% IRR hurdle, a realized IRR hurdle. So after paying all of your distributions since inception and fees, etc., if you meet a 12% hurdle, thereafter there's a 20 to 80 split. So the manager will take 20% of the excess cash flows on a running basis, and you'll get 80. Given how these deals are structured, that tends to be a very back-ended event. So it often happens when the equity investor elects to liquidate the transaction. And once you get all of your money back, pay the debt holders, some portion of that excess proceeds to the equity may be due to the manager. That's really the fee structure on that side. Separately, I believe the other question, Marty, I'm having trouble pulling up the questions. Just give me a quick second here.
The other question is,
Turnover.
in the private loan market, banks are charging borrowers a minimum interest floor of 2%. Are
Right.
CLOs doing the same?
So the loan market went through a period when rates were very low, where about 80% of the loan market in the broadly syndicated world had a LIBOR floor. Typically, that's 1%. As we've seen competition for allocations in primary loans over the last 3 years, with most borrowers mostly just refinancing and not having much new M&A activity, what we've seen is LIBOR floors have suffered. So today, on average, I would say 30 to 40% of CLO portfolios have a floor, and it's typically an average of 1% for that floor. That's actually very meaningful for a levered transaction, because the excess on those floors actually doesn't have to be paid out to the debt holders. It has to be paid out to the equity, just by virtue of how the math works out. So that is an important point to raise. Today in the post-COVID world, we're starting to see the fledgling reemergence of the leveraged loan market, and many more investors are insisting on LIBOR floor features in new transactions, and that's generally very accretive to the equity because it's a positive mismatch in your favor. I think the other question was about the turnover in the portfolios. I didn't get to that. Effectively, CLO managers have very different styles. You can see annual portfolio turnover of 10% to 40%, depending on the style of the manager. And that's really depends who you partner with in that situation. Turnover is good for some investors, bad for others, and it depends if it's successful turnover. Equity investors generally like to have active managers who can capitalize on dislocations, who can reposition portfolios at the right time. Debt investors may not necessarily want that much activity because you risk eroding value in the portfolios. So I see, okay. I don't see any other questions. So if that's it, I'll be happy to move on.
Absolutely, please.
Thank you. I want to talk about the OC test. So this is an important topic today. Effectively, one of the reasons why CLOs performed well throughout the crisis is that they're non-mark-to-market financing structures. What that means is you have certain assets and then you have liabilities. Your liabilities are not called or forced to trigger a margin just because the price of your assets has gone down. CLOs depend on the actual performance of the underlying loan portfolio, meaning if you have CCC downgrades and if you have defaults in the portfolio, or as mentioned, if you trade assets and perform poorly, you lose par value, as we call it. So for any performing assets in the loan portfolio, there's an asset coverage test. We call it the OC test, the over-collateralization test. The performing assets are counted as at par in the numerator for that test. The non-performing assets, we're talking about CCCs and defaulted assets, get haircut. And that haircut is typically a combination of using a market value instead or using a rating agency determined recovery rate, which can be very punitive. What's important to know is CLOs are allowed to own 7.5% of their portfolio in CCC assets. Anything above 7.5% gets haircutted at market value. And the way that trigger works is you pick your lowest price assets, and those lowest price assets get applied to the haircut first. In most markets, we haven't seen CLO CCC buckets balloon to 7.5% in a very long time. Today with COVID, one of the catalysts that we're seeing for the opportunity is that CLOs are hitting those triggers, and that's caused a lot of price volatility in the mezzanine tranches. Unless there's any specific questions, I'll come back to this point, but the OC tests are most important initially for the equity and the junior mezz tranches, and I'll explain why very shortly. Just going back, I think this is a very important point. It goes back to the bid-offer spread question that we had, and it's very important to understand how the secondary and primary markets for this asset class work. Who owns CLO tranches? So the AAA part of the capital structure, a lot's been made out of Japanese banks being the biggest investors. Actually, U.S. investors have the majority of CLO AAAs for the U.S. market. We are talking about, these are the large blue chip tier 1 investment banks that have CIO divisions that buy this for the treasury. In Japan, you have a large collection of agricultural cooperatives and the large blue chip banks that buy CLO AAAs as well. The insurance market is a very sizable investor in the space. Beyond that, you have asset managers, you have mutual funds, you have pension funds. Again, CLO AAAs in normal markets have been structured to pay, call it LIBOR plus 1.2% to LIBOR plus 1.5%. Comparing that to what's available in your traditional fixed income alternatives, talking about corporates, etc., that is very attractive on a running basis, and it's also a floating rate asset that offers some upside in case rates rise. Turning to the AA to BBB part of the capital structure, you start to see a lot more insurance involvement in this part of the capital structure. You see U.S. regional banks become more important. Asset managers, mutual funds, etc., often acting on behalf of insurance firms and other investors that don't have the in-house capability. Turning to the BB and perhaps single B parts of the capital structure, hedge funds become much more prevalent. Asset managers. Then you see multi-strategy credit funds. This is an important point because we've seen a lot of crossover activity. So you might have had people presenting to you about non-agency RMBS trades or other opportunities that have been quite attractive post-crisis. A lot of those multi-strategy funds that tend to try and find the opportunity at any point in time actually navigated to CLOs in the last few years because yields were a little bit more outsized compared to what they could get in the non-agency trade, for example. It's important because we'll talk about how each of these funds operates with leverage. Lastly, going to CLO equity. Historically, I'm going to talk pre-2015 and post-2015 for this. It's a very important distinction. Pre-2015, the owners of CLO equity were firms like DFG that raised money from institutional investors who want to earn a levered return on corporate credit. You have a very good host of well-regarded firms that have done well, that have been active in the space for quite a long time. You also have permanent capital vehicles. So some of the BDC market has invested in CLO equity using the other bucket. There are dedicated CLO equity funds that you can buy that are listed that have a bit of an interesting fee structure and maybe some leverage as well that you have to understand before investing. And then you've also seen insurance firms come in with combination note purchases. What's so important post-2015? As part of the Dodd-Frank rule, the agencies, the regulators required that securitizers of risk hold 5% of the securitizations that they produce. Why that was perhaps a bit aggressive for CLOs. If you were a small or mid-tier CLO manager, DFG is a good example, and you're now asked to buy 25 million of risk in a $500 million transaction, you just don't have that kind of capital at hand. Moreover, we argued as the industry that more than 60% typically of our fees were conditional on performance as it was. So you did have quite a bit of skin in the game. However, regulators included CLOs as part of this, and the sizing of that requirement at 5% was something that prompted a lot of fundraising from CLO managers. So some of you may have seen various CLO managers coming out with risk retention funds. So rather than having third-party professional firms control the structuring of the CLOs, the timing, the quality of the arbitrage, what that regulation did is it basically really forced some of these firms to amass war chests of capital from LPs into funds that they sort of direct in order to control the timing of their deals. And that is also partially responsible for the growth we've seen over the last 3 years in the space. Managers being pressured to put that capital to work in drawdown private equity structures. I don't see any other questions yet, so I'll move on. How did CLOs perform through the GFC? This is always an interesting and controversial point because there's been a lot of comparisons to the CDO market or to the mortgage securitization markets in the CLO space. The facts are that in CLO debt, over the last 25 years, this is S&P data, only 40 tranches have experienced a principal loss or a technical default. That's a remarkably low 25-year cumulative default rate for this asset class. Effectively, if you bought a BB tranche at 90 cents to the dollar in the primary market in 2007, you got all of your interest, you got all of your principal. That being said, you might have hit enormous price volatility while you were owning that at the trough of the crisis. We can talk about that more. But generally speaking, CLOs did what they were supposed to do. They diverted, when those OC tests broke due to accumulation of defaults and downgrades in the loans, they diverted cash flows from the equity tranche, which is how that mechanism works, to pay down the AAAs and reduced the AAA size, thereby correcting the OC test by reducing the numerator. So the deals that emerged from that process had less leverage and were in a better position, were able to resume reinvesting and paying dividends to equity. The equity tranche is even more controversial because you would have thought that taking 10 times leverage against corporate credit in 2006 and 7, right before a bubble, would have produced a really poor return. Actually, pretty uniformly, CLO equity performed very well through the crisis on a hold to maturity basis. So if you actually held your securities, most deals ended up with mid-teens IRRs. And it's a very interesting concept. And the reason for that is once these OC tests cured and the deals were able to resume paying cash flows, suddenly the managers found themselves in a much higher reinvestment opportunity market. It's sort of, you can compare this a little bit to catastrophe insurance. You get hit with a hurricane and you feel like your entire premiums are wiped out, but the next tickets you start to write are at much higher levels. And that's one of the beauties of CLO equity. It's also made possible by the fact that you have this non-mark-to-market financing structure. So CLO equity investors were not forced to liquidate these deals at the worst possible time. They were just forced to earn nothing in the short run. And on average, CLOs that failed OC tests did so for about 9 months straight. So you went through 3 quarters of zero distribution as an equity investor. Another important note, the AAA part of the stack has never experienced a default, certainly not a principal loss. In the COVID era, there are a couple of deals that are doing very poorly that we expect to have a technical default, but we'll take all of their money back for sure. Don't see any questions right now, so I'll move on to the next slide. Going back to CLO equity, we took an example. This is BlackRock Senior Income Series 2007-5. This is a 2007 vintage equity. This is the actual cash flow profile that this security paid, and the bars that you see in the graph are expressed as a percentage of face value. And these are not annualized numbers. So each quarter, this equity was designed to pay maybe 4 points or 4% of par on the par value of the equity. So this is something that was supposed to pay 16% per year, 16 to 20% a year. but actually had a very dramatic difference in cash flow profile. So what we saw, the deal made its first 5 distributions. The average in 2008 was actually 7 points, which is better than probably what they modeled. 2009, they had a 6-point or 7-point distribution. Thereafter, this equity didn't pay a cent for 1.75 years, so 7 payment periods in a row. Now you can imagine the impact that has on the valuation. Let's say you bought this security at 80 cents on the dollar in the primary market, you struck that, that's where you struck the purchase price, and suddenly you've earned 0 for 1.75 years. That resulted in massive drawdowns in the valuation. And in that period, it was very difficult to see where default rates for the broader loan market, downgrades, and performance was going to be. Right? You're in a period where you have unprecedented stress in the US economy. You had very significant stress on a good number of sectors that CLOs tend to lend money to. Right? The auto sector was a big one, printing and publishing, real estate and construction. Those are segments that really were hit very hard during the financial crisis. So it's natural that this equity would have traded at an extremely poor valuation if somebody were to take it off your hands at the throw of this. We also didn't have the historical track record and data we have today to actually be able to understand how bad default rates can get. And that's part of the reason why those securities went so low. Thereafter, once the OC tests were cured, the AAA was delevered, and suddenly the structure is passing again. This equity, the first payment was pretty low, but thereafter you see that things have jumped from sort of the 5% range to the 7.5%, 8%, and even 10% range. This is the manager having the ability to capture wider spread reinvestment opportunities post-crisis. And that persisted for a very long time. And you see the very significant 30% plus distribution, that those are effectively liquidation proceeds. When this deal was finally liquidated, how much money were they able to get back in the last payment? And cumulatively, from the point where this deal resumed cash flows to its end, it paid about 172% of its face value. And imagine if you were lucky enough to buy that in the 5 to 15% of par value price range at the trough of the crisis, that was an incredible multiple opportunity. And we'll talk about why today is different. We certainly don't see any opportunities like this in today's market, but we are seeing similar stress and attractive valuations in CLO equity.
Hey, Alex, I just wanted to jump in here because I know, and you just brought up that today is different, but it would be great just to understand how today is different and whether it's too early to tell. Because I think we're still pretty early in the cycle of what's going on, right?
Correct. And I think I have some good materials for that that'll help illustrate. But generally speaking, why we think today is different, if I had to summarize the key points, one, the sectors that are being hit with a very different type of stress, right? When we talked about the crisis, you had certain sectors that were hit hard, and there were specific reasons for why they were doing very poorly. And as long as you got your sector backed correctly, managers were able to do well. So those that avoided buildings and real estate, auto, etc., printing and publishing, had a much better outcome uniformly than those that were heavy in those sectors. Today, we're seeing a lot of historically rock solid industries hit by a very different type of stress with COVID, right? So that's, in my view, that's one of the key differences, and we can talk about that in a bit more detail in the following slides. In addition, a good chunk of the loan market today is covenant light. So 85% of the loan index in today's world is now covenant light. That's one of the poor things that's happened post-crisis as a result of a lot of capital coming into the loan market. There's some nuance to that as well. The bank revolvers, so typically when banks create these LBO deals, they syndicate the term loan B to investors like CLOs and to mutual funds, asset managers, etc. And then they usually retain the term loan A's or the revolvers on their balance sheet as part of their relationship with the underlying borrower and the private equity sponsor. Typically what happens is those securities tend to hold covenants, whereas the institutional loan market no longer has substantial covenants. And in fact, many of us would argue that the companies that have covenants in the institutional market are very poor performers, and you probably don't want to invest in those anyway in this environment, frankly. But that's represented a loss of control. So when we talk about the reinvestment opportunities that we will see once CLOs cure their tests, we think that not having covenants will reduce your ability to extract fees from some of these borrowers, right? Whereas in the crisis, by and large, amend and extend activity was a very big trend. And what that did is it allowed CLOs to recoup some of their economic loss associated with the poor performance of these borrowers, potentially giving them a maturity extension, etc. So combination of the sector stress being very different, as well as the reinvestment opportunities not being dominated by these amend and extend fees going forward. That's not to say that the spreads won't be higher on new issue loans, and they certainly will. It's just the degree of that is going to be more subdued. So, let's see.
So you said the degree will be greater, but is there going to be more loans that are problematic?
Generally speaking, we'll get into some stats in the subsequent slides. We had $90 billion of defaults in a $600 billion market back in 2009. That was the record. All right, so today, this year, we're already at about 26 billion of defaults, but we're in a 1.3 trillion market. I don't think, we at the firm don't necessarily think that the stress is going to be as bad as in the crisis, provided that we don't have a COVID 2021 scenario. That's what we call it internally, but no solution to this well into a year from now. We think the loan market will recover, actually. And it's just a matter of getting them the types of support that they need, which has been mixed so far. But generally speaking, it's we don't expect it to be that poor. I see another question. What annual IRR is reflected by 172%? If you bought, at that point, it's you're talking about a 15 to 35x multiple from the purchase price in if you're able to buy it at the cheapest price possible in the secondary market back in 2009, for example. But really, you have to think about multiples in that scenario. That deal, however, if you think about the original holder that bought this at 80 cents on the dollar, got, call it 28 points. Let's say you've got 200 points on their face value over the life of the deal. We're talking about a mid-teens IRR. So Marty, with that, I'd like to jump into a little bit of the opportunity set today, and we'll talk a bit more about your question on the risk going forward.
Yep.
So just a quick refresher, credit markets obviously faced a historic sell-off. We've overlaid the 3 last great cycles, and to an extent we should have maybe shaded the 2016 commodity crisis as well. But looking at the default rates in each of those cycles, the orange line represents leveraged loan spreads, credit spreads to maturity. High yield bonds are in blue. In the 2001-2002 cycle, we saw default rates for the loan market peak at around 7.5%. In the GFC, we saw a 10.8% record. It's important to note that CLOs had a bit of alpha to this number. Morgan Stanley calculated that the median default rate for CLO managers was about 6% at the same time. So there is a bit of, there are definitely some missed bullets that CLO managers can be proud about in the crisis. And then moving to 2016, you see that spike. That was largely an oil and gas, metals and mining commodity crisis. And you really had to filter for deals that had that type of exposure. You had some managers that took very public strategies in those areas that did not work out well. And moving to today, loans and high yield bonds effectively blew out to about 1,000 basis points or 950 basis points DM at the peak. We've seen since a decent amount of tightening in both of those asset classes, largely on the back of what the Fed has done and some of the treasury support the market has seen. With that, I wanted to talk a little bit about what's happened with CLOs. We had a very sharp dislocation with CLOs in March. Going back to the slide that we talked about who owns these transactions, there was one very, very significant AAA investor that was forced to sell about $7.5 to $10 billion in a very short amount of time of AAA securities. That was, we're talking about the order of weeks. And as I mentioned, a very substantial part of that buyer base is a buy and hold investor base. They do not take that, that's not available for sale on their balance sheet. These are long-term investments. So there's actually a dearth of investors who can go in and aggressively act on that type of volume. And what that did, CLO AAAs, for a very, very brief moment, touched the low 80s percent of par. It was an extremely sharp sell-off. One buyer just jamming paper through. It's public knowledge who they are today, but I won't repeat it. The dealer community responded by investing in those securities. Moreover, what's important to note, the Fed included CLO AAAs as part of their discount window, which allowed primary dealers or banks to provide repo financing to their clients to buy AAAs at decently attractive terms. So that opportunity was pretty quickly cleaned up. We're talking about a matter of a couple of weeks. We saw stuff rally back into the 90s. Today, the average index price on the JP Morgan CLO index is about 97.6. That compares to close to par at February end. Naturally, though, when AAAs are trading down to the 80 cents in the dollar range, that creates a significant ripple down the stack. If you wanted to own AAs in the 90s, you have to revalue that now. Single A's, you have to revalue it all the way down to the double B's and single B's. And naturally, what you saw is mezzanine debt holders were extremely reluctant to trade in those periods. We saw a lot of trading volume shrink at the peak of this, and certain managers were able to capitalize on opportunities there. In our case, our focus at that time, because of some of the uncertainties, Marty, that you pointed out on how default rates might look, we were mostly focused the single A, triple B, and some double B part of the capital structure during that phase, capitalizing on what was a significant dislocation in investment grade CLO debt as well. Today, as I mentioned, stuff has rallied. The single A through triple A part of the capital structure is no longer in any dislocation. Those are certainly very attractive relative value investments if you compare that to your Barclays, corporate aggregate index, or your US Ag, which is the general benchmark most treasury departments use. Looking at triple Bs through single Bs, the index levels are such where triple Bs are in the 90 cents range, double Bs 80, single Bs 60. Those correspond to credit spreads of 500 to 1600 basis points and yields of roughly 6 to 17% to maturity. Important point that we're quoting these to maturity because, as I mentioned, CLOs tend to have a bit of duration uncertainty because of these call options. If you're able to buy something at 80 cents to the dollar, and instead of paying you back in an expected 5-6 years, and you get paid back in 2 or 3 years, a substantial improvement to your realized IRR. So there is a lot of upside in this. CLO equity, on the other hand, we are generally speaking at 10 to 60% of par. Huge dispersion, a lot of focus on underlying portfolios, the quality of those portfolios, where they are, and that's justified because realistically, there is uncertainty about the path forward. There are even some CLO equities that are trading at 1 cent on the dollar. We were offered a package around that level, and we just could not bid on it because we felt that it wasn't worth a cent. Those deals are so far in the red because of their portfolio positioning that it's simply not attractive risk reward at that level. And so CLO equity is really less of a technical credit spread driven security. It's more of a fundamentally sensitive investment proposition, which is why we haven't seen it rally in sympathy with perhaps CLO investment grade, mezz, or for that matter, the underlying leveraged loan market. If you look at the leveraged loan market and high yield market, which is sister markets here, we are 3 to 4 points down versus February, which is remarkable when you think about the type of stress that this industry has seen. And a lot of that has been on the back of the technical intervention and the Fed supporting these markets, perhaps indirectly for the loan market. I see we have a question here. Why not just invest in individual loans? And why buy a CLO which may have exposure? It's a great question. Generally speaking, if you like taking on individual risk and you think accumulating a portfolio of loans could be attractive, your expected returns on that type of a trade are sort of in the LIBOR plus, on a yield to call basis, LIBOR plus 400 to LIBOR plus 600 range. That's sort of where loan portfolios are being created today. Quality loans that you like will be created in the mid to high 90s on the dollar, right? The index price is at 92. It's because there is a significant tail that you just cannot invest in today. The whole purpose of CLOs in particular is to invest in diversified portfolios where you don't have to take specific sector views, at least not in overweight fashion. And you trust that there's a CLO manager there that actually has a track record, a good understanding of specific sectors, and is able to select those loans, and you benefit from enormous diversification in that underlying risk. Manager generally cannot take a greater than 1.5% position in any single name, and generally doesn't take more than 10% in any sector. And that is a diversified way to get access to this market, generally speaking. And when you look at a CLO portfolio, there's so much transparency associated with that. I think you get monthly trustee reports, so you really see what the manager is doing. You see what the exposure is. If you have the right systems, you can really get involved in that process. And it's easy to really filter out transactions that have high energy exposure or high metals and mining, overweight in retail, sectors that are really hit in this COVID scenario. I think I saw a second question there, which relates very well to the first one. Can one find CLOs that have no exposure to airlines, energy, restaurants, and retail? Zero is probably a no. We actually did a very comprehensive study on this across every CLO manager in the market, and we found that the range of exposure to sectors, including these, but adding sort of the metals and mining commodity space as well, and adding certain auto and transportation, we found that the range among CLO managers is about 12% on the low end to what we call COVID hit sectors, up until 40%. So it's very easy to filter out that 40% portfolio. Other investors in our space may have a different approach. They might think, well, a big chunk of this portfolio is beaten up. I should just price it appropriately, and I should put a bid on this CLO equity or debt reflecting that. I think in our case, we tend to be a bit more conservative and try to focus on the higher quality, more liquid profiles in the market. Let's see, I'm seeing a question. Bid-ask spread in a normal market for single A-rated CLOs are 50 to 100 basis points, single Bs 200 to 400, and equity 500 to 1,000. I'm talking about this on a price basis, right? In a normal market, you might see half a point to a point in price for a single A. Single Bs I would say would actually be wider than this. We're talking about at least 5 to 10 points in the normal market, and equity also in 5 to 10 point range. On a yield basis, it's actually tighter than that. So hopefully I've been able to answer those questions. One thing I do want to come back to is, you have the underlying loan market that's rallied pretty significantly, and the high yield bond market has rallied pretty significantly in the back of what the Fed has done. But generally speaking, a lot of the programs that the Fed has put in place don't directly benefit the loan market. Some of these are sponsor-backed companies that exceed the leverage caps associated with some of the aid that the Fed has provided and made available. And that's one of the reasons why you have to be very careful when looking at these portfolios. So Marty, with that, I'm going to jump to the next slide, which will also help understand some of the dispersion in the space. So in the scatter plot, what we've done, the y-axis is credit spread. The x-axis is years to reinvestment period end, so it's a proxy for tenor. And the different colorings of the lines, effectively the orange lines are what the market perceives as tier 3 CLO managers. So firms that maybe smaller, have a shorter track record, or are poorly perceived because they, let's say, blew up on energy in 2016, or made mistakes, or had a lot of turnover in their teams, etc. The blue dots are the tier 2 managers. These are largely investable firms that everyone recognizes, everyone has exposure to in some respects. And the tier 1 managers, the darker circles, are the top tier managers that everyone thinks are money good. You have great track records, great brands, and by and large, you can expect that any of these firms, barring a few exceptions that we think have undeservedly acquired some great reputations, generally these are managers that have been performing pretty well or are well regarded. Their bonds are more liquid because the next investor in the secondary market knows these people, knows their teams, their brand, etc. And you see a pretty wide range of dispersion on CLO BB prints in the secondary market throughout the month of May. CLOs trade through two mediums. One is just direct over-the-counter trading. So you're picking up the phone, calling a dealer, asking what inventory they have, asking whether they're looking to cross inventory from other clients, trying to make a deal. 40% of all trading volume actually happens on publicly listed auctions called BWICs. These are bids wanted in competition. Why I wanted to put up this slide is it just shows you an incredible range of risk and return profiles that you can pick from in this market. And on the tight end, on the bottom left, we have a deal. This is actually a static transaction that didn't even have a reinvestment period. This is more similar to an asset-backed security where the manager picked a portfolio up front. That portfolio is now returning capital progressively to investors. That traded at around 800 basis points discount margin. So LIBOR plus 800, we're talking about a mid to high single digits or high single digits yield to maturity. Higher upside if you're able to call the deal faster. On the other extreme, if you look at the top 2 points at the top of the chart, we have a tier 3 manager and a tier 2 manager that printed BB trades at LIBOR plus 2400, reflecting what must be enormous stress in those portfolios. Those deals are also fairly short, They have a year left and change on their reinvestment period. So the manager doesn't have a whole lot of time to make accretive trades that'll help them get out of their situation or improve the OC tests. And in the case of a double B, what happens sequentially, first the equity starts getting shut off if you fail your OC tests. However, if the failures continue to ramp up, you have more defaults and downgrades that outweigh the deleveraging of the structure, and your test continues to fail, your double B can pay in kind, which means that rather than being paid interest, you're paid additional face value and you're owed more in the future. Double Bs, triple Bs, and single As tend to be pay in kind securities in that respect. On a double A or triple A, any pay in kind or any failure to pay full interest on any payment date would be a default. Just wanted to illustrate the type of range you see in this market, and there's a lot to pick from. Our philosophy has really been to try and find value and act opportunistically into higher quality profiles.
Hey, Alex, we have about 10 minutes left. Did you see the other questions that were asked on the bid-ask spread?
Right. Yes, I think I covered those, Marty. We're talking. I just confirmed that we're talking about price basis, and on the single Bs, it's a much larger range.
And the question on individual loans versus CLOs?
I think we covered that as well, Marty.
Got it.
Gotcha. So moving on, just wanted to illustrate the type of stress we've seen so far. So in the 3 months, March, April, and May, Moody's and S&P downgraded about 400 billion of loans, or 370 billion of loans. That's nearly 1/3 of the leveraged loan market. Naturally, the agencies have been accused in the past of being slow or complacent. Given what we've seen in credit markets over the last few years, they've been much more aggressive. Even last year, 2019, there was a lot of news and attention to the fact that some of these transactions were very highly levered, had significant add-backs and adjustments assumed in the financial projections, and that agencies were giving credit to these borrowers. And what that's done, now that we've seen the COVID stress, the agencies were not slow to act. And we saw, in particular, S&P being much more aggressive on some of the loans that they rate. On a combined basis, eliminating the overlaps, you've seen about 30% of the market be downgraded. 10%, 1/3 of that 30% has been to triple C. It's an important point. It slowed down in May, 42 billion versus 180 in April. But the reason for that, I think we've gotten through the first wave of downgrades. Right now, the market is really, really focused on Q2 earnings. Most of these borrowers are private. So what's going to happen is, as they report, CFOs report in, call it August, then we're going to see the agencies take another look at the performance and see whether it merits another wave of downgrades. On the default side, we've had about 26 billion year to date. That's significantly lower than 90 billion we saw in 2009, but it's certainly a big number, and downgrades tend to be a forewarning of eventual defaults. April alone saw 13 billion versus an average of 5 per month over the last 5 years. Naturally, as defaults and downgrades accumulate, we're going to see them pressure CLO performance further and pressure CLO tranche pricing. Seeing another question here, are participants using CDS to hedge their CLOs as in prior economic periods? Generally speaking, on that question, it's a very good question. It's hard to hedge CLOs using individual CDS, right? And what you often see in those types of trades is a disconnect between the technicals that govern the individual CDS trade and the pricing of the overall CLO. Because hypothetically speaking, you could pick the tail assets in the portfolio, take some insurance against them, and that should be fine. But two points. One is the disconnect that tends to happen between those two trades, and the other, that's a much less liquid market today. The loan CDS universe has become much less prevalent in today's market. Right, I'm seeing another question here. Are you marketing a specific fund or vehicle to take advantage of the dislocation, particularly with respect to the more subordinated parts of the capital structure, triple B through equity? So generally speaking there, we'll turn to this in a second. We think that for family offices in particular, and most of the institutional clients that we interact with, we've more been focused on the mezzanine and equity parts of the capital structure. The arguments for both are very different. Basically, the mezzanine part of the capital structure is a very strong relative value trade. If you focus on the higher quality bonds, we think that's a much better place to be than in the high yield market, than in the leveraged loan market in direct fashion. And frankly, we think it should be compared to private credit. A lot of investors have looked at investing in some of these direct lending funds, which certainly have done well in the past, but we've seen a lot of compression in spreads in those areas as well. We think that as family offices consider the mezzanine space, that's sort of the comp. You have the publicly traded alternatives as well as the privately traded alternatives in that sense. The equity part of the capital structure is a different animal. It should be compared more to a distressed trade today. We are having conversations with investors about those types of opportunities. Generally speaking, we think that is a capacity constrained opportunity. We could not see ourselves deploying more than 500 million in a calendar year in that area. And we're not seeing sellers come out in waves just yet in that regard. I'm also seeing a question on why CDS declined in popularity. I think the banks have just not been offering that same type of individual protection on specific names anymore. I think demand has also dropped significantly because some investors have gotten very burned in that space. We can definitely follow up with a more thoughtful answer on that point, but it's when you do see managers active in the CLO tranche investing space hedge, they typically tend to use CDX, high yield, or IG indices as hedging mechanisms instead of single name hedges. And frankly, even those are challenging to get right. Marty,
Alec, I do have one more question, which is related kind of what Leonard Levy's been talking about, but I'm wondering, what is the size of the CLO market versus the private marketplace for this sort of thing? Maybe you can talk about it. And, also we've had a lot of experiences, and I think Jeff Michel's going to talk about it later, where, we're seeing massive defaults along the areas that Leonard brought up earlier. And so, how is, I know that you kind of answered it, but if you can answer again, how CLOs are protected from that, that'd be great.
Sure. I mean, and Marty, to your first question on size, I think the CLO market at 700 billion compares, pretty well to the private credit market. I think I've seen the latest estimate for that sort of in the $800 billion range. And some of the participants in the call may have better views on that than I do. But generally speaking, CLOs are built to withstand the underlying credit pressure, right? Especially CLO debt. Typically speaking, when a CLO tranche is rated BB, the agencies to get to that rating mandate that the tranche should be able to withstand typically 6 to 8% defaults per annum using a historical average default rate of 70%, right? So that's sort of the rule of thumb where CLOs have gotten structured. So you're buying a BB tranche, assuming that if your CLO performs poorly and 8% of the portfolio defaults every year at a 70% recovery, you're going to get close to getting your money back. This is very draconian baseline stress. It's certainly different than what we're seeing today. Today, the risk is a spike, right? And the path of defaults tends to matter as well. But these are securities that are built with quite a lot of protection from day one. The AAAs are extremely hard to breach. The triple Bs are extremely hard to breach. Equity is where where that risk tends to sit, and that's where a lot of the fundamental performance tends to hit first.
So the difference is credit quality and recourse, I guess.
Well, yes, you have two factors that actually give different tranches different protection levels, Marty. So one is straight up credit enhancement. So like an asset-backed security, if you were to buy an auto ABS deal, right, and assuming, I'm throwing out numbers just for illustrative purposes, assuming the equity, the residual tranche in that deal were 10%, once 10% of the portfolio is lost, meaning you've defaulted and you've recovered less than your face value, defaulted, recovered less than your face value, etc., up until the point where 10% was eroded, that's where the equity would no longer have any value, right? CLOs have that feature as well. It's called subordination. So typically a BB tranche has, call it 8% par subordination as well. So you have 8% of the portfolio would have to be eroded, all else equal, for you to lose your first dollar of principal in that trade. The equity is about 8% of par value below you. That's one. Two, the OC test mechanism is what we call structural enhancement. Well before you hit a point where you're losing principal, the OC trigger comes into play, right? So once your erosion reaches that trigger level, suddenly the equity stops getting paid. And that money gets used for AAAs to amortize the structure. And once that structure amortizes, your deal can come back into compliance. But that also has the effect of protecting the BB tranche as well. Because the manager is not going to go crazy trying to buy the riskiest loans they can find if they're further putting themselves in the hole on their equity distributions as well as their subordinated management fees. So you have two layers that really protect investors in the structure And Phil looks like he wants to jump in on something.
Yeah, so in addition to the structural features that Alex has described, when we are buying equity and when we are buying mezzanine debt, we look into the portfolios to see the concentration into these COVID sectors. And if we see a portfolio that has a high concentration and is very risky, we want to make sure we're getting the pricing and the security that compensates us for that risk. And if we don't like the credits and we don't like the pricing and the value, we won't buy that security. And if we're managing an account for a client that wants to avoid that kind of risk, we just look for the managers that have the lowest possible exposure to COVID sensitive industries, these travel and leisure industries that have a long road ahead of them in their recovery. So it's both asset selection on our part, and of course we think we've got a good credit team that helps us understand the underlying portfolios, plus the underlying structure. Even if we make a mistake and there are losses, the structure itself can protect an investor from the debt investor from those losses. So I wanted to make sure that folks understood that we have the ability to actually see the credit of the portfolio that we're investing into.
Right, and Phil makes a great point. Systems are very important there because you get a 300-page PDF a month from every CLO you invest in. What you do with that data is really what governs how you're able to risk manage your portfolios. But Marty, maybe with that we can move to some of the next slides because I think they'll illustrate the questions a little bit better.
Sure. You have about 5 minutes, Alex.
Great. So looking at slide 17, 34% of CLOs as a whole were failing their OC tests in May, at their May reporting dates. That was about 21% in April, and 21% deferred their April payments. The next payment will be in July. We think that number is going to accumulate to about 45% failures by July. That's going to continue to put pressure. By comparison, in the crisis, 73% of CLOs had at least one equity payment missed, and the average for deals that missed payments was about 3/4. That gives you a little bit of a flavor for how bad we are today in terms of the performance, where we are in the cycle. Moving quickly here, the agencies have also taken action in CLOs. They've put about 36% of triple Bs and 60% of double Bs on watch for downgrade. They're citing the OC test, erosion, exposure to COVID hit industries, and increases in triple C assets as the reason for this. And we also think this is going to be a catalyst for further price volatility going forward, particularly when you think about those crossover investment grade high yield buyers like insurance firms for buying triple Bs. They may not be as incentivized from a capital standpoint to hold triple Bs. Jumping here just to illustrate the stress runs a little bit better, we actually took a broad approach to stressing the CLO market. We took every CLO double B in the market, applied a 50% default rate over the next 12 months for all of the COVID sector names in those portfolios, and a 10% default rate over the next 12 months for all the non-COVID sector names in those portfolios. For the entire universe, that's like a 20% default rate for 12 months. We think that about 25% of the universe is more directly impacted by COVID sensitivity. Looking at the chart, this is the historical average default rate for the loan market. You're seeing, the last few years we've sort of been sub 2%, and the historical average is typically 3.5 to 4. Banks are projecting rates to go up anywhere from 5 to 13%. JP Morgan, I think, is around 8% for the year, is what they're going forward, what they're projecting. And we wanted to stress the market in a uniform fashion to show how well CLO double Bs in particular can actually withstand pressure. So moving to the next slide, a little bit of a busy chart. Apologize for that, but what we found in the results, what we're showing on the y-axis are the combination of interest and principal cash flows to the double B tranches in CLOs that we model based on that COVID stress. So assuming that we're going to default 50% of their COVID names and 10% of the non-COVID names the next 12 months at a fairly severe recovery rate, we're talking about 50% of par versus a historical average of about 70 to 80. What we find, if you're on the right side of this graph, you are receiving more than your face value back through a combination of interest and principal. And bear in mind that today, if you were to buy a double B tranche, you're likely paying 80 to 90 cents in the dollar for it. So you're actually in the black as soon as you get anything more than your purchase price in that sense. And we find that 65% of deals are going to survive and do well, and 35% of deals will not recover face value through a combination of interest and principal. That illustrates some of the stress. That being said, this is a draconian scenario. A 10% default rate for the non-COVID names is very punitive, but it's just there to illustrate that CLO double Bs have inherently the ability to withstand stress. I'm happy to discuss this in greater detail, but maybe we should take a break there for questions. Marty, I think we're basically at the end of the deck.
So,
yeah.
Alex, someone asked a really important question, which is, can you buy CLO equity at pennies on the dollar?
Good question. So today, like I said, CLO equity is offered at 10 to 60% of par. Those are the equities that we would consider investable. Even then, at 10 to 60% of par, the 10% is more of a distress profile. This is a security that's likely not going to pay you anything for the next 2 to 4 quarters, but has enormous upside value, and may have the potential to generate 2 to 5x multiples based on that price. And then the 60% equities are typically deals that were structured in 2019 and early 2020 that have much more certainty in terms of their cash flow profile, that have a longer reinvestment period for you to be able to actually play there. And deals that are trading, unfortunately, at sort of 1 cent are there for a reason, and that's really option value. And the only way you can really recover anything there is a very sharp V-shaped recovery. So hopefully that answers the question.
Alex, I want to just ask a couple more questions, and then hopefully we can draw this to a close. But so there was a question here about a specific fund or vehicle. I'm not sure how you answered it, but I mean, you guys have several funds set up. You're not marketing a new fund, correct? You already have funds that are created to handle the situation.
Correct. So we have an open-ended fund that's been mostly targeted to family offices that we launched in March of this year, and we have some other vehicles that are focused in CLO equity. So we don't have a new fund that we're actually out marketing today. And Marty, for compliance reasons, I'm not going to get into too many specifics on that front, but that's sort of the overview. We have some existing vehicles.
Understood. I think there was a question or two more, and then hopefully we can draw to a close.
Right. I think the question: are there any specific rules that force insurance companies to dump downgraded CLO tranches? Good question. No. So what we expect is many insurance firms will have to do the math on their capital charges. They may be facing other issues in other parts of the portfolio as well. But generally speaking, we think some insurance firms are going to have to sell downgraded triple Bs to reinvest in other opportunities that make more sense from a capital adequacy standpoint on their part. And lastly, the way to short CLOs, unfortunately, there's no direct short selling in this market. There used to be a lot more activity pre-crisis on, as you know, like the Big Short in terms of being able to write those types of contracts on structured products. But that market's largely gone.
Well, that's great, guys, and thanks so much. Do you want to make any closing statements? I mean, so we're going to make everybody's information available to you, and your information available to everybody else, so you can send them a copy of the presentation. And also, we have a video library, and we'll just post your presentation on the video library, and the people who signed up for this will be able to access it.
So Marty, let me just make a quick closing comment.
Yep.
This market is a very complicated market. The securities themselves are complex, and each security is different from the other. There is no generic double B. There's no generic equity, and it is a market that the government really isn't putting its heavy foot into. The government is touching it slightly in the AAA sector with very specific rules, but it is not a market where the government is causing significant demand and price fluctuation that makes it difficult to find good value. There are outstanding, we think, risk-return characteristics in this market, especially in the lower-rated debt tranches and in equity. And we have opportunities for, we have multi-investor strategies that allow opportunities to come into the market. and we'd be happy to talk to people about them. I've got a significant amount of my own capital in these strategies, and we welcome others to learn more about the opportunities.
Fantastic, guys. I think this is an ongoing discussion, and I'm sure it's going to be last as long as COVID. So thanks so much for the presentation. It's really fantastic.